Welcome to Valuing the Deal. This session will help you in creating a better form of negotiating deals, especially licenses, as you move forward into transitioning your technology from your innovation to someone else's commercial product. My name is Laura Shappy. I started Fuentek in 2001, but I have been working in the field of technology transfer for about 20 years. And during that time, I've helped analyze thousands of technologies that have led to hundreds of deals. I have an engineering background coupled with business experience and a business degree to help in that process of communicating technologies forward and finding the best value for them. Working on developing a good negotiation process and improving the deal value really depends on having a very proactive and strategic approach to how you manage your intellectual property. So this session really assumes that you have gone through the process that we call the filtering process to really analyze your technologies and narrow down to those that have the highest value. Just as a recap, the basic concept is you start with a large portfolio of technologies with unknown potential and value, and you rapidly screen through those to identify those technologies that deserve a deeper look, but also to remove any technologies that are not going to be high potential, to either passively market them until the next intellectual property coverage payment is due, or remove them from your portfolio completely so that you do not commit resources with those technologies that are not likely to produce any return on investment. The next level is a deeper dive analysis, a market-based assessment of the technology, and that's where you develop more of a primary market research look at the technology to augment the basic of what we call secondary market research. So essentially you're calling potential licensees and decision makers in the industry to verify that your technology is a fit to their needs and has potential. Through that, additional technologies get removed from the process as being identified through that primary market research as not necessarily having as high a potential of a return on investment as what might be required to move it forward. The next stage is marketing that technology, and that is vetting through educating potential players on the value of your technology and securing their interest in it and bringing them to the negotiating table. We have webinars on all three of those steps, and this is the webinar for that last step, and that is the deal-making portion of it. When the interest is verified, the technology has a fit, how you move it forward into securing a deal. So licensing is not easy. Just because you've gone through those steps doesn't mean you're going to secure a license. One of the main reasons is because often technologies are developed for their own purpose. If you're a research lab or a government lab, you probably were developing the technology for some other need rather than what the market needs. And if you are a company and you are looking for a non-competing use for your technology, you developed the innovation for your purposes, but not for the new use that you're going to be fitting. So that's a first starting point of why this can be difficult. Often we'll find that these technologies are pretty embryonic. They're features or capabilities. They're not the full product. If it were the full product, this would typically be pretty easy because you know what the market is and you know how it's going to fit. But because these technologies are a piece of the bigger picture, it tends to be a little bit harder. And if it's embryonic on top of that, meaning it's very early stage, hasn't been fully developed or fully understood, especially if it's going to be a disruptive technology, valuing that can be quite difficult. And it always involves a pretty large risk on the side of the licensee. They don't know if they're going to be able to take that technology and fold it into their product line and create a new market for themselves. And again, if the technology is embryonic, they're going to have to invest in further development of that technology. So it's a pretty big commitment on the side of the licensee to enter into this agreement with you. So there's lots of challenges, making sure that you are distinguishing between what the technology is and what the market needs. So just because you've created a really cool widget doesn't mean somebody out there desires it or needs it. And making sure you take a look at the value of that technology based on how each of the different partners is going to apply that. Because you could have multiple licensees, or a single licensee may have multiple applications for your particular innovation. And it's never a simple formula. It's never a one-size-fits-all, and the application that one user might have might be quite different from another. And you also have to rely on making sure that you've got good information and good data. We say garbage in, garbage out, meaning that if you don't provide good information going into the analysis, you're not going to get good results on the back. So no simple equations, no simple answers, and every deal is likely to be different. Now, making sure you take a look at the technology from the perspective of the market means that you're thinking about it in terms of what solution it's providing, not what the innovation itself is. In other words, you don't buy a drill because you just want the drill. You buy it because you have to make a hole. You need the function that the drill provides. And often there could be multiple different types of products or different customers. So you need to look at each one of those differently and value them differently. In one case, it may be that you have software that's being added to one potential partner, and in another case, they're going to sell it as a service and not as shrink-wrapped software. So those are two very different propositions and two different ways of creating revenue. And you always want to make sure that you're focusing on the value that your innovation brings to the need. We always use better, faster, cheaper, that if you're commercializing a technology or transferring a technology, it better be one of these aspects. Otherwise, why would the market want it or need it? And the market will only exist when those customers or those licensees find value in it. Again, just because you think that you've got a really cool innovation doesn't mean that anybody wants it, needs it, or is willing to pay for it. So you've got to think in terms of the perspective of the partner and where they're coming from. Helping you do that means that you want to understand what matters to them. Gaining a competitive advantage is a very typical one. They're trying to increase their market share, reduce costs. Again, that better, faster, cheaper concept, that something is being brought to them in value, and that's why they want your innovation. So it needs to hit some aspect of their need from their perspective. So let's get into a little bit of what the licensing process is to make sure that we're all talking in terms of the same language. First off, a license agreement is much more than just a piece of paper unless it's being used for defensive purposes or litigation, infringement. And this webinar is not addressing that type of analysis. That's actually quite different. So in this case, we're really looking at it as more of a relationship building, not just signing a piece of paper over and saying, good luck, see you later. More things often have to occur to make sure that you build a strong relationship that's going to last for a while. To do that, you want to make sure that you understand where that partner's coming from. Again, I gave you the perspective of what they care about, that they're trying to increase their market share, reduce their costs, things like that. Essentially, what you're trying to get to is what's their pain point? What is not working for them right now? What are they trying to achieve? And if in those discussions, as you're building that relationship, you understand what that pain point is, then you will be able to have a better understanding of what their goals and objectives are, and therefore understand the value better. Walking in their shoes means making sure that you understand how they are structured and how they need to achieve whatever goal that they've sent out for themselves. So, for example, if it's a startup, they're not going to have a lot of cash on hand. They rarely have money, and so it could be that you need to structure the deal in a way that allows them to be successful early on in the process without taking all the cash out of the business. I had one case with a large organization that had licensed a technology to a startup, and they were very proud of themselves because they had signed a deal that required the startup to pay them $1 million within 6 months. And they told me about the deal, and I immediately said, you're going to be either renegotiating that deal within the next couple months, or they're going to terminate it and go do something else. And they were quite shocked and said, why would you say that? I said, because they're a startup, they do software, and they need cash to pay their developers in order to make your product go to market. And so they can't possibly be successful unless they have that $1 million to invest in the development of the product. And as soon as they go to an investor and ask for money, that investor, a venture capitalist, is going to say, no go, you've got to change this agreement. And that's exactly what happened. The company called me a month later and said they've come back and their VC has refused to give them funding unless we renegotiate. And so we did that. We renegotiated and flipped the agreement to not require the $1 million up front, but pushed it out over time to make sure that the startup had the money to invest in the product, create success, and then pay back for the license. So walking in their shoes means you understand their structure to figure out how you can make this deal move forward in a way that will allow them to be successful and you to regain value for your technology. Researching the partner and what they do and how they do it, having conversations will inform a lot of that, will help you understand where they're coming from and what's important to them and why, which will lead to figuring out how to create deals that are positive for everybody. So going back to that case where the large company was very proud that they were getting $1 million, they did not create a situation that allowed their partner to be successful, and therefore they were not going to get any money and certainly not going to get their $1 million, let alone any royalties that would be created on the back end. And so you have to create something that is going to be beneficial to everybody so that it is self-sustaining. And always be timely in your responses. This can sometimes be difficult, especially if you're working in a government type lab environment, but it is critical to move forward and keep the ball rolling, keep discussions going. Because if you don't, your licensee or potential licensee will go find somewhere else to get that innovation. And so you will lose the opportunity if you don't provide them with timely responses and stay engaged. Now, having set the stage for how to work with the players, let's now also talk about what the key components are within a license to make sure that we're, again, all talking about the same basic pieces. So the first is, what types of rights are you going to be granting with that license? The typical ones are non-exclusive, which means multiple people can have access to your technology and use it in many different ways. Partially exclusive or exclusive within a field of use may be that you only allow 2 licensees to have the technology, or 1 licensee is allowed to have it in the area of medical devices while the other one is allowed to have it in the area of transportation. So somewhere between a non-exclusive and then the most stringent is the exclusive license, where 1 person gets it, they are the only one allowed to use that technology, and nobody else can have access to it. That variation in how many players can use your technology and what fields they can use it in usually correlates to how much they have to pay. So a non-exclusive licensee typically will pay less than an exclusive licensee, and partially exclusive will be somewhere in between those two. Now there's also room for some discussion on who has the responsibility of different aspects associated with the patent. Typically, the patent owner or the licensor is the one that maintains the patent. That means they continue to pay for the patent fees to the patent offices, whether it's WIPO or the U.S. Patent Office. And they also provide a warranty of ownership, meaning that they do, in fact, have the assignment on that patent and that they are in a position to be able to grant the license. There are certain things, depending on what organization you are. For example, government labs and universities typically will not provide any kind of validity on whether you have freedom to operate. If you use their technology, their patent in your product, that's really going to be your issue. And so they typically will not give you any information on whether their patent works for what you want to do. That's part of your due diligence if you are the licensee. So it's the responsibility of the licensee to perform due diligence on freedom to operate. Another aspect within due diligence is defining milestones, when you will bring the product to market, and other key things that are typically done in a milestone. Again, milestones refer to certain points in time where the licensee will achieve a certain goal. If it's a startup, a milestone may be that they will receive $2 million in investment by the end of year one. Another typical one is prototype development is done within 6 months to a year. Product launch is within 2 years. Each case is going to be a little bit different. It may depend how complex the technology is. On pharmaceuticals, that tends to be a much longer time frame for milestones. Software tends to be very short milestones because it's easier to launch it, and there's a lot less cost normally associated with launching a product in software than in pharmaceuticals. Other things that are normal requirements for a licensee is that you will pay licensing fees, whether that's upfront fees, royalties. It could be in certain cases, if you have an exclusive license, that the licensor may ask you to pay additional patenting costs. They would still have responsibility for filing for maintenance costs on the patent, but they may ask for you to cover the cost of it. Normally, you would see that only in an exclusive license arrangement, not in a non-exclusive. The other aspect that is interesting in an exclusive arrangement is that subcontracting is often allowable. So if I have an exclusive license from you, it allows me to get a subcontract with the technology, a subcontract on the technology to somebody else to move that technology forward in a different product area. It may also allow me to sue for infringement. For government organizations, it is also concerning that a government lab cannot sue for infringement. And so by giving an exclusive licensee, they would be allowed to push the responsibility of suing for infringement out to the licensee, which is a great thing. Licensee also has reporting requirements, whether they are exclusive or not exclusive. So another aspect of licensing that can be difficult at times is indemnification, and that's who has legal responsibility for anything that goes wrong with the product using this particular technology. Most times, research organizations and government labs who are the licensor will have no indemnification. They will say, we have no responsibility whatsoever in what happens with your product if it harms or hurts anybody. Therefore, they can't be sued if something bad happens. This is a big issue in the United States. It may not be as big an issue in other countries. There may be other terms that are particular to organizations that are not negotiable. For example, with NASA, the space agency in the United States, the use of their logo, the blue circle with the red swish in it, is not allowed with any product. You can say a factual statement of this technology is licensed from NASA-developed technology, but you can't put the NASA logo on that product. So those are terms in addition on their license agreement that can't be altered. And most organizations, especially large ones, whether they're large companies, government labs, or research organizations, will have certain terms that by law they have to have them in there, and so they can't make any changes to that. And as a licensee, you have to be aware of those and either accept them at the beginning or walk away and go find technology somewhere else, because those terms cannot be changed and cannot be negotiated. As the licensor, you want to make sure you know what those terms are so that you do not offer that those can be changed. Now, there's other things to be concerned with when you are licensing a technology. One is the right to improvements. So if you develop a technology today that allows for analysis of a pharmaceutical, that's a great technology. It has a certain value associated with it. But as you continue to work and improve on that technology, it turns into an innovation that will cure cancer. That's a huge difference in what the value of that technology is. So you want to be very careful when you're negotiating the rights to any improvements in your technology that you're not giving too much away, or that you're putting a time limit on how long any improvements will be transferred as part of that license. As a licensee, you want all the rights to be moved over to you, but as a licensor, you want no rights. There'll be some ground in the middle that will be appropriate depending on the technology and depending on the value of the deal. If a licensee requests longer or more rights to improvements, they should pay for that right. So it is a value aspect to the license. Confidentiality means if we enter into this agreement, maybe I don't allow you to publicize it and tell anybody about it. This just needs to be clear. It's not necessarily a problem, but for public institutions, they often want to publicize who they're working with and may have a requirement to do that. So be aware of that and make sure that it's compatible with your business practices. Licenses, again, unless they're for infringement, will likely need to have some transfer of know-how, and that's more than just signing the agreement. That means you have to have time of sharing information and know-how. The ability to sublicense. Typical is that an exclusive license conveys with the ability to sublicense the technology, and if you are going to allow for sublicensing, what's the value on that revenue? Will it carry through, or will it be a different percentage? For startups, for example, if you say your license rate is 3% on any goods you sell, and you want to have a pass-through that if they sublicense it to somebody else, it also needs to be 3% on any revenue coming in, that may ruin the ability of that startup to sublicense that technology out and make revenue, because for their product, that 3% may have been appropriate because the product they were going to sell was 100% related to your technology. But if they sublicense it, it now becomes a smaller component to somebody else's technology, and requiring that they need 3% on that may not be realistic at all. So be very careful how you structure the sublicensing revenue generation and make sure that it is logical and something that will not ruin the ability of your licensee to be successful. Again, the ability to enforce against infringement, non-exclusive usually do not have the ability to take care of that, but an exclusive licensee does, and there could be very strategic reasons why you want to manage that. Milestones and triggers are things that if they don't comply, if they don't reach the milestone agreed upon, then something may trigger off and say you have to give the license back or you pay a fee because you did not achieve the goal that we expected. You always want to make sure you're monitoring the performance of your licensee and know what's going on and get reports back, and that you're getting paid. You'd be surprised how many organizations spend a lot of time and money getting a license in place, but then forget to ask to get paid a year, 2 years, or even 5 years later. So make sure you're getting the reports and getting paid regularly. And ensure that the innovator is available in case you do need to do a transfer of know-how, because they are the most logical one to help on that process. Now, in the process of licensing, again, we've done hundreds of deals, and early on in our activities, especially working with research organizations and government labs, it was incredibly cumbersome and could take forever. There was one deal that took 2 years, which is crazy. Surprised the licensee was still involved. So we developed what we call the two-step process to be more efficient and also be more fair in how many resources we think it should take to move the negotiation forward. Part of the reason behind this is because you keep pushing an action item between the two parties, and so that keeps the dialogue going. If you ask for the licensee or prospective licensee to fill in some paperwork and they're not ready to, that's because they're really non-viable. So it really is a way of forcing a commitment out of your licensee and not having conversations that go on for months at a time with no real commitment moving forward. It also makes sure that you don't scare off your good prospects. Because with a lot of these large organizations, the paperwork required can be really cumbersome. It can require commercialization plans, development plans, marketing plans, and that takes a lot of time to develop. And so if you've got a good prospect, you don't want them to feel like, oh man, there's so much paperwork, how am I ever even going to start on this? This really breaks it down into two parts so that they focus on the business aspects first. So you really think in terms of business terms of what the cost is, what the value is, and then get all the rest of the paperwork put in place. Because if you're not able to come to an agreement on what those business terms are, what the royalty rate should be, what the value of the technology is, the rest of it is irrelevant. Why waste any time doing the rest of it? We also find that people get more committed once they come to an agreement on those business terms. So the two-step process initially it's a single piece of paper when it's not filled in, but once the licensee fills it in, it's typically 3 to 5 pages because they're providing you with some information about them and also their offer. And so it's that initial term sheet, and then it's a pro forma, which I'll show you examples of both of those in a moment. And it helps you in focusing your negotiation on just those business terms first, and then moving on to part 2, which is the much more cumbersome business plan and marketing development. It works really well because we've seen it. The big change in how long it takes for these agreements to move forward, and also the ability to get people to commit faster and move into an agreement faster, because it is so much more efficient on their time. They're only using the resources they need when they need them. And if you can't get past that first one, you haven't wasted a lot of time writing reports that are of no value to anybody. And it also, by using the pro forma, employs some negotiating techniques that, again, we'll discuss in detail in a minute, that help in making sure you're going to get the best value for the deal, and that everybody understands where they're coming from, what the value is, and how they're going to move forward and be successful together. So it puts everybody on that same page again. Now the advantages are, as I said before, it gets you to a deal much faster because you are working in smaller chunks, and so it's not so scary and cumbersome for the licensee. And you can figure out where your differences are and resolve them quicker without focusing on what the license agreement looks like and what the legal language is. That comes later. It's also been clear to us that once a company commits to what the value of the technology is and what those business terms are going to be, then it's much easier for them to put the resources forward to filling in that other paperwork that's often a requirement for executing a licensing deal. And so they're going to be a better partner with you. And so you really are working your side of it, if you're the licensor, only on those deals that are progressing forward. And on the licensee side, they're only writing what they need to when they need to. You will also be in a better negotiating position because you will have better data and better information right from the start, because the licensee has given you that initial offer. It is a form that often when you start the negotiating process, each side is waiting for the other one to give that first offer, and nobody wants to be the first one. But if you say, we have a process, you have to fill in this paperwork first before we can even enter discussion, it removes their ability to wait on you to give that first offer. And so if the licensee puts an offer on the table, they've now set the floor. In other words, you will not go any lower than the offer they have given. But if you were the first one to put an offer out, you've set the ceiling. The licensee will not give you any more money than that first offer you put on the table. So it's a technique, and it's a very important one because it sets the starting point for all discussions. Now, a typical term sheet is going to ask for information about the licensee, who they are, what size company they are, basic information, and also what they're looking for the technology. What fields of use do they want? What level of exclusivity do they want? What are they asking for? How many of your patents are they looking for? And then what's that royalty structure? How much is the upfront fee? Is it a ascending or descending royalty rate structure? Is it going to change year by year? Whatever that is. And also minimums. So every year they agree to pay you a minimum amount of royalty regardless of how much product they sell. Hopefully you've both done it in a way that those minimums are never needed, that you are fair in what minimum requirement you put down, so it incentivizes the licensee to sell product, but it doesn't create a problem that they can't possibly meet it. So you want to be fair about that. And then milestones. What are they going to accomplish by when? And these will be very different, whether it's a startup, whether it's software. Again, deal by deal, these will look very different. Now, this form can, in many cases for us, the one we typically use is 1 page long. It's a Word document, and then they add information, so it turns into about 3 to 5 pages once they've filled in their information. But you can make it whatever structure you want and add additional information that perhaps you may need at that initial point. But I advise you to try to keep it as simple as possible so that it is not too cumbersome for the licensee to fill out. Now, pro forma sheet, and this is just one example, I'll show another one later, is just a way of committing, and we use Excel because it's an easy way for you to do some manipulations afterwards, of projecting what the sales are going to be on that technology over a reasonable time period. That time period is probably going to be 3 to 5 years, but it totally depends on what type of technology is. If it's a pharmaceutical, it could be the full 20 years. So be realistic about what a revenue stream could be, and don't make it so long that the numbers are complete guesses and have no validity and no logic to them. What it's trying to get at is how you're going to be selling, or how the licensee is going to be selling product, whether it's services or units, a combination of both, different products, so that you have an understanding of how your technology fits within each one of those product areas and how you can attach the royalty to each one of those revenue streams. It could be that it's logical to take 10% on product A and 5% on product B. This is a very simplified form, but just to give you an example of how you may structure it. And then make sure that you understand, if they are going to be selling services on top of the product, that you get some value on that as well. We've seen in some cases where a licensee was going to take software, for example, and negotiated a license and said, yeah, for every software package we sell, we'll give you 15%. No problem. Well, that was the only way the royalty structure was defined on that particular deal. What the licensee ended up doing was saying, we're only going to end up selling a couple of these products. What we really want to do is sell our services. And so customers will buy our services and we'll give them access to the software for free. Well, in that case, no royalties were due because the agreement was not structured in a way that the licensor could capture value on services. It was just the units of software sold. So this allows you that visibility to understand where their income is coming from and what value you bring to that. And there's a series of manipulations that we do in analyzing this to really understand what percentage of the product your technology is attributable for the sales and other things that go into it. But essentially, you want to keep this as simple as possible. There are very complex pro forma forms out there that are in excruciating detail of every cost of goods and sales and general administration and everything you can possibly think of. Most companies are probably going through that exercise internally as they analyze whether they want to move forward with your technology or not, but they are not going to want to give you that level of detail, nor do you need it. You need the basics. You need to know how much revenue is going to be captured and what's the general cost associated with that, so you can see what the cost of goods, so that you can see what their profit margin essentially is. And in the ballpark, you don't need to know exactly every single dollar. You need to know approximately so that you're sure that you're getting a fair value for that technology. So once they have filled in the application, the initial term sheet, and the pro forma, there's things that you will go through in evaluating. Typical is that you will look at their commercialization plan as part of phase 2 once you come to terms with the business terms of it. You'll take a look at the development and manufacturing capabilities they have. This is really that stage 2 or step 2 level of what you're looking at. Make sure they've got the financial resources to be successful in moving forward. This is where that, startup, make sure that they've got money coming in or that you haven't taken all of their cash so that they can't move forward. Critical. They could tell a great story on their commercialization plan and their manufacturing, but have no money to actually execute on it. And then what venture capitalists often will focus on is, do they actually have the management to be successful in that? VCs will focus very heavily on the management team for a startup. In larger organizations, this tends not to be quite as critical because they have pretty robust management structures. And then, do they have the capabilities to market the technology and get the distribution out there? This is part of your due diligence as a licensee in taking a look at these capabilities, and they were also doing due diligence on their end to make sure that the technology would work for their product development and their product growth. But there's more to due diligence on the licensor's part than just taking a look at the paperwork that a licensee submits. We like to do background analysis on who the player is to make sure that what they're submitting is in fact accurate, and also that there's no hidden issues. Had one case with a small business that was applying for a government lab technology, and we did this background analysis, and it turned out that he had a record. He was being investigated by the SEC, and there were newspaper articles out there about some other issues. And so for the government, that is not the type of public relations you want. And so that was not somebody that was likely to operate in good faith, and you didn't want to get messed up with their legal issues. And so it's important to also do due diligence on the company and the people that you are working with. Especially on a small business, you probably aren't going to get a whole lot of information on the company, but you can on the individual. And that will help make sure that you are operating with people who are operating in good faith themselves, that they are being honest, and that they are people that you want your organization to be known doing business with. So you're looking for court records and articles and things like that, but what you really care about is making sure you're not going to have some scandal on the back end. And part of that is because a license is a long-term commitment. It may seem like it's pretty quick, you just sign some papers and you're done, but it is a long-term before you are likely to see any money, and so you want to make sure that you are working with people that you believe in, you have faith that they are being honest with you, and they are able to move the technology forward, because it is much more costly to get out of that license agreement than it is to get into it. And so you don't want to have to break up after a while, and it's also often bad PR because if you're a government lab or even a research lab, there's a lot of stakeholders involved in your organization, well beyond just the dollars that are potentially coming out of that license. And if you're a company, your reputation is very important, and so you don't want to jeopardize that by working with somebody who's not going to be successful. So think in the long term, not quick transactions. Now that we've taken a look at the license structure, let's talk about how you actually value the deal in order to determine what those royalty rates should be. So value comes in many shapes and forms. The first is the economic. That's pretty straightforward. It's how much money is going to be made, and it's easy normally to attach the royalty to whatever those units are. Then there's the strategic. And that could be a company's desire to grow their market or protect what their current market share might be. They may have some other aspects specific to their business structure of what they're trying to achieve from a strategic perspective. And then there's the emotional. They feel that they must have it for whatever reason. NASA, again, one of the clients that we work with, there's a lot of companies that have a great love and desire for working with NASA. And so that emotional value of saying, I've licensed this technology from NASA has value as well. And so there's the rational aspect of creating value, and that's looking at the numbers and knowing you've sold so many units and your market share has increased by so much, that are pretty straightforward, easy to put some numbers to them. But then there's that premium that comes with the perception aspect. And you're going to find out about these emotional or strategic components that are going to add value to what you're bringing to the licensee through those conversations. And so you want to be paying attention from the very first day that you talk to this potential licensee. And that could have started back when you were assessing the technology. So make sure you're taking good notes, and that when you're entering that negotiation process, you go back and review those notes as well as the market research you did to really get a full picture of why do they want this technology and what are all those different pieces and components that are bringing value to them in utilizing your technology, so that you can put value in it for you, that you retain some of that value back. So the approaches that exist out there for performing evaluation are market, where you take a look at what's happened in the past and see what transactions are similar to the one that you're putting in place. Cost, which says how much would it take for your licensee to replace the technology that you're giving them. That one doesn't always work, because if you have a patent that basically it covers the use of this technology no matter how or what, then there is no cost for replacement. They have to license it from you. That doesn't always happen, but it is a possibility that cost is not a form that can be easily used. And then income, and that's the one that we often base the most on, and that's the utilization of that pro forma to really have an understanding of what future cash flow is going to be as resulting from that technology. So let's take a look at each one of these in a little bit more detail, and then an example. So market approach basically means you go out and take a look at past history, and each industry could be quite different, and what those typical ranges are for what you would see in a license. And so this gives you an idea of what to expect and a reasonable position. So if you were negotiating with a licensee in, let's say, electromechanical machinery, and they came back and said, I'll give you 0.5% for a royalty rate, you could use the market approach to say, that's completely unreasonable, because pretty typical is somewhere in that 5% range. So I think you need to multiply that by a factor of 10, and then we can keep talking. So it's a tool in the negotiation process, but it is not a guarantee. So just because history has shown that electromechanical machinery has been in that 3 to 10% range does not mean that's the value your technology is bringing to this licensee for this technology. It's just a range. It gives you a concept. So in the cost approach, that is not the same as how much money you spent in developing the technology. Whatever you spent in developing it is considered sunk costs, and that means it's irrelevant. I don't care how much money you spent developing it. All I care is how much it's worth to me in moving forward. So many people will mistake the amount of investment they put into a technology as being the value of that technology. It's not. They have nothing in common, so throw that out. Now, a lot of organizations, especially government and research labs, will retain the cost of patenting as part of the negotiation process. They have a right to do that. You're welcome to put that out there, but the licensee may say, not my cost, and I really don't care. If it's a non-exclusive, it really is not their cost, because that is part of of your retaining the intellectual property. If it's an exclusive license, then you legitimately could say, to continue to have this patent coverage, I have to pay $20,000 in year 2 and whatever those dollar amounts are, and therefore, since you're the only user of this technology, you need to pay that in addition to the royalty structure. So you'll take a look at that cost aspect of it a little differently depending on the scenario. But what you're really trying to get at for the cost approach is, what would it take the licensee to develop that same technology themselves if they were not to license the technology from you? That doesn't mean they would be infringing and doing exactly what you did. It would be doing something similar to what you did. So software is a really easy one, and I'll use that as the example because it's the code itself. You could write the same code differently, and so you would not be infringing on them, but what the code does is what's of value. And so how much time would it take for somebody to duplicate the functionality of that code? Is it worth it to them to get to the market sooner and not have to pay those developers and license it from you instead? So you want to focus on what it would cost for them to essentially work around and have a different solution but achieve the same goals as what you are offering them. In the income approach, you're using that pro forma in order to really analyze what it is that they are producing, how much revenue they're anticipating, and doing a fair calculation so that they retain enough profit to make it worthwhile for them to produce the product, but also that you're getting fair payment. You also want to make sure that you are doing good market research. And a lot of this will come out if you've done that technology assessment and worked on analyzing the technology and doing primary and secondary market research. You would have gotten a lot of good data. These are the players. This is how they use the technology. These are the different products in which it could go in. This is approximately how many units are sold per year. It gives you an idea of what to expect when you get the pro forma back from the licensee of, are they being realistic and are they being honest with what the technology is going to bring to them for market. So, for example, if they come back and say, we're going to sell 5 units at $10,000 a piece per year, and you know that these units are selling for $5,000 with their competitors and they're selling hundreds of them, you can say, this isn't going to fly. You're not going to sell a lot of these units, and it's just not realistic, and we want you to be successful. So please take a look at this market data and be more reasonable and rational in how you're structuring. We often see that we have to help startups more because they don't have as good an understanding of the market, and making sure that they provide reasonable and rational data. Large companies often have a very good understanding of what the market is, what the pricing points can be, and things like that. But again, that market research helps make sure that what they are providing you in the pro forma is realistic and that they're not trying to rip you off. So it's a good way to keep everybody honest. And then the other aspect that the market research can help you with if you've done that technology assessment is making sure that you understand the percentage of your technology to their product. So often, most of these technologies in tech transfer, it's not a complete product that is going straight to market, and so you're responsible for 100% of the value of the product being sold. It is more often a feature, a capability, a widget within a larger product. And so you need to really understand what percentage of that product sale am I really attributing with my technology. That's important because it helps in calculating the royalty. If your product is only 5% of the total value being produced by the product, you're not entitled, and it's not realistic for you to ask for a large percentage of the profit that they are making. You will only really be entitled to a smaller percentage, and that's part of that calculation that goes into using that pro forma that we have on the back end once we receive that data. Now, where do you find this information? There's a lot of data already out there on existing royalties, from SEC filings to one database that we use quite often, Royalty Source. You can get a lot of information on past royalty information and market information. Another resource that can be quite useful is two associations that will do surveys on a pretty regular basis. LES, Licensing Executive Society, does it, I think, about every 3 to 5 years. They will do a survey to all of their organizations, and these are corporations, and they'll ask them, tell us about your licensing deals. What were the percentages? What fields were they in? How many were exclusive or non-exclusive? And so you'll get some pretty good indications of different industries and what the averages are in license agreements by looking at the LES data. AUTUM, the Association of University Technology Managers, is for universities, and so they supply on a yearly basis. They fill in information about how much revenue they're making in their royalties, and they're about to launch a new database, I think within 6 months or so, of licensed deals. So it will be a pretty detailed and equivalent to Royalty Source in the amount of information that will be available on different deal structures. And one of the most important sources for getting data, it will be from industry experts that you talk to about what value this particular technology is going to have on the product, and also from the licensee himself of how they're going to use the technology, and the performance statement that they provide to you will give you a wealth of information. Now let's take a look at an example and go through the 3 different ways of analyzing what the value of a deal might be. So the first is that market approach. So what has the market paid in the past for similar deals? So you want to search those databases. Let's say you take a look at Royalty Source. You use your keywords and you come up with about 100 deals that fall into that category of the particular technology you were looking for. So just a couple of quick examples that we've done recently. One was a medical device on endoscopy. Another one was for mattresses. We found no data for mattresses. We found a lot of data for endoscopy. And another one before that was for biofuels. And we found some relevant deals. So what you're looking for there is it's in the right sector, it's got the right kind of keywords, and as much similarity to your relationship as possible, so that it's similar in the type of technology that's being transferred or the level of development. Let's say from that search that you did, you come up with at least 3 that look pretty comparable to the deal that you're trying to pull together. And so you analyze those 3 to kind of get an average of what royalties have been paid in the past. So in this example, it's 2.5% to 3% royalties were average what was paid for similar deals. And the market research you did from having done the assessment before tells you that the expected revenue for selling this product is about $4 million. And so what that tells you is that if I were to get about 3% royalty on $4 million of total product, my royalty revenue potential is somewhere around $120,000. Now, in the next case, we take a look at the cost approach. Now, I'm going to pretend this is software, so we've got a way of analyzing, and they actually could work around it and recreate the technology themselves. So in this case, again, it's that cost to reproduce. You're going to get this information from talking to the licensee, but also you as the licensor can take an estimate of this. It's not your sunk costs, but if you had to do it over again, what would it cost you? So essentially, you can estimate based on knowing you had 5 software programmers and they worked over an 8-month period. So worst case scenario, it would cost as much as it cost you. But the licensee will give you some indication about that too. And then subject matter experts, those industry experts that you talk to, will also be able to give you some insights into what would it cost if you had to do this today. And so you come up with an estimate of how many hours it might take to develop that particular package, and then an average hourly rate that is reasonable for who that licensee is, and you come up with an estimate of cost to replace of about $117,000. So this is without looking at any of that emotional or strategic aspect of how long would it actually take them. Let's say they might take 18 months to develop that. Well, that's 18 months they're not at market. Those are additional values you might be able to add to there. Here we're just trying to get some hard numbers. And so ballpark cost to replace for this particular technology would be somewhere around $117,000. Now, in the last case, you want to look at the income approach, and that's estimating those future revenues. So you ask the licensee to fill in a pro forma statement, and that, in this case, we project that it's going to be 5 years of realistic revenue. It could be 3, it could be, I think 7's pushing it. So we typically go 3 to 5 years, again, depending on that technology. And you ask them to give you some very simple, basic information of how many units, what the unit's sale price is going to be, what their cost of goods are, and any R&D costs that they're going to be applying for this technology and this product. Not for the company as a whole, but just specifically the investment they're going to be making for making this product successful. And then what's their upfront fee, what royalty rate are they proposing. And so using the pro forma income statement, it really gives you an estimate of where your royalty stream is going to be coming from. Now, on top of that, we do these back calculations of making sure we're getting a reasonable attributable portion of their profit margin. So by asking them to fill this form in, we essentially can estimate their profit margin by taking a look at their revenue and their costs. We know what their profit is, and then we want to make sure that we're getting a percentage of that profit and that that's reasonable. I'm not showing that here because that's part of our proprietary process, but I am telling you that's essentially what we're doing. So you could probably figure out how to calculate it yourself. But this is the form that they would fill in and the information that they would offer as their initial offer. And so from what they are offering, the cumulative net present value of the royalty revenue would be about $157,000 over that 5-year period. So that also tells you that your estimate of $4 million in the revenue potential is about what they said. And so that's why having them fill in the pro forma and comparing it with some of that market research helps you make sure that they're being realistic and honest with you, and also helps you in estimating the value of the technology. So if you compare all 3 of those, what you're looking for is that convergence range, that this is in the ballpark. And so all 3 of these are pretty close. They're pretty reasonable and rational. So if you end up anywhere in that ballpark, or better yet, if you make more than that, then you've done well, and it's a pretty well thought through royalty structure and analysis if you're able to achieve somewhere in that $150,000 range total income for your royalties. So what that translates into, if you back it out to you think the market's going to be somewhere around $4 million, that it's about a 3 to 5% royalty rate will equate to getting a total revenue of royalties in that $150,000 range. And that 3 to 5% is totally in line with what you saw from looking at past deals that were in that 3% type range. So this is all very reasonable and rational. And if you're having that discussion, that negotiation with the licensee, and one of their numbers, if they come back with an income statement that is saying they're going to pay you $90,000, you can say, no, I don't think that's reasonable, and here's why. Because the market tells me that past players have paid so much, and that I should expect that you're going to be making about $4 million, so that's way too low. And I know that it's going to cost you at least this much to reproduce what I'm giving you, and that's not even taking into account the fact you're losing market share for the next 18 months because you're going to have to redo this all yourself. Why should you prepare? If just having gone through that example doesn't help you understand why you want to make sure you've got background information, let me give you a few other things that you should be looking at. why is this particular person licensing your technology? Carrot licensing to us is, that's a positive process of why they want your technology. They want to build product. They want to use your innovation because they're going to sell product. And so that's a positive thing. You're dangling a carrot in front of them saying, this is great, you want it because you're going to be able to make better widgets than what you have now. Stick licensing is because they are already using your technology, and you are now forcing them to get a license before you perhaps sue them for infringement, or if somebody is interested in taking your technology or your patent and using it in infringement cases. I'm not really going to get into the details of that last statement of they want your patent because they're going to use it for troll type activities or infringement cases, but I am going to look at this in terms of if you do discover somebody using your technology and you first approach them and try to negotiate a license before you sue them. So these same techniques would be used there. If they fail and they refuse to get a license from you, then you do need to go to court and sue them. But we often find that if you approach people and want to have a discussion with them and say, hey, I think you're using my patent, let's talk about this because I think we can reach a reasonable license agreement so that you can continue to produce product, will work most of the time. So we advocate that approach first. And then the carrot license always is on that positive end where both parties are entering it before a product is made because they want to find value. Doing that analysis of the comparables that are out there, both from a revenue, the royalty license, but also an understanding who the players are, how they're using technology, so that you understand how your licensee is going to be making product and what range of volume those products are going to be, as well as the prices on them. Any discussions you've already had with the licensee are tremendously valuable. They have given you insights without potentially knowing it in why they want your technology, in how many units approximately they're selling. There's a treasure of information that has come out in each of those discussions as long as you were listening and taking good notes. And it won't just be that the economic pieces, those special added value elements will be those strategic or emotional factors of why they want your technology and where it brings value for them. So making sure you're paying attention to that information as you move forward and accounting for it as you do the back and forth in the negotiation process. And then obviously that economic analysis is that straightforward, that everything will start there and then be added on top of it. Now, part of the process of negotiation is you're still selling. You may have marketed the technology, they've expressed some value, but that actually never stops. You are constantly making sure that they understand you bring value and making sure that they appreciate that value. And so doing that research ahead of time so that you can say, hey, I understand one of your suppliers was in Philippines. I could use as an example since that just happened, was in the Philippines. They just got hit by a typhoon, and so their factory is down. And so it's probably strategically valuable for you to be able to make this particular component in-house so that you are no longer reliant on exports and a source that is not necessarily reliable. So that's part of selling and constantly reminding them of why your technology is going to add value to them. And also making sure that they're being fair, that you are showing that you've done your research, and so when they tell you that they're only going to sell 5 units, you can say, no, I'm pretty sure you're already selling 50 units, and so what you're telling me right now doesn't make any sense. So they treat you with respect, and they recognize that you understand the market and what's going on, so you're credible in this process. Another aspect is that we often find for research organizations, whether they're government or university or private, is that they've got a lot of stakeholders, and these stakeholders need a lot of reassurance and justification as to why this deal is the way it is. And if you negotiate 3%, they're going to say, why wasn't it 5%? doesn't really matter what you negotiate, they're always going to think you should have done better and more. And so having done some of this research helps you justify back to your stakeholders, this was fair and rational for these reasons. So it protects you internally as well as helping your credibility externally. And often you may think that the licensee you've got in hand is the only thing that you've got available to you. That's not always true. If you've done your market research, especially if you did that assessment, you've identified multiple players. And so you may be talking to player A today, and they may give you an offer, but they may not be the best player available. And if you have the potential of working with a bigger organization or somebody who's going to bring more value, having done your research, make sure that you're not settling for the small deal, that you've got the ability to capture that bigger deal. And as I said, making sure that the other side takes you seriously and that you do know what you're doing, because that will always help you improve your position and get that higher value for the technology. And the final reason for doing this is because you better believe the other side is researching what their other options are and trying to figure out how do they reduce the value. And so if you don't prepare, you are jeopardizing your value and your position in this, because they will be prepared, especially if it's a company. So in the negotiation process, your goals are to make sure that you are being very clear about what you are trying to achieve and what the alternatives are. That doesn't mean you tell the licensee, hey, if you don't give me this, I'm going to go to company B. You should never name company B, number one. But you can provide hints of, we're willing to have these discussions with you for the next 5 weeks. At that point, we have other alternatives, and we're going to be moving on. And so that can be incentivizing, but you also want to be very honest with them on this. And it helps you anticipate what they're trying to achieve and line up what your offer is with what their goals are and what their alternatives might be. And always what you're doing is trying to maximize your value and minimize the risk. That's what they're doing as well, but hopefully you'll be able to meet some middle ground where you are reasonable about the risk that they are taking on because they are investing in your technology. Your risk is really one of the deal you didn't take. So if you don't give them the license, then is there somebody else that you might have given the license to, and would they have been a higher value? So again, doing that research ahead of time, make sure that you know who all your options are, where they might land in the landscape, and also gives you the opportunity to perhaps carve out different portions for each one of those opportunities. So one may be very strong in medical devices and the other one might be very strong in transportation. In that case, you don't want to give an exclusive license to a startup who's not going to be able to pursue both of those market sectors. You may allow them to pursue one of them and then have a different licensee that can move forward with the technology in a totally different sector. So minimizing your risk of exposure from that perspective. And then it will also help you know where those deal breakers are, where the boundaries are, that you can't ask for $1 million up front because they don't have that cash or that's unrealistic for the value of the deal. Knowing where your limits might be. And your limits may also include the lowest that you're willing to go because you do have that next possible option available to you. And as you go through the negotiation, you want to give them reasons as to why you're counter-offering. So they give you that initial offer of 0.5% and only selling 5 units. Well, you don't want to just come back and say, no, I want 10% and 1,000 units. You want to say, I think it's more realistic that we are in the 7% range because this is what's happened with the market, and I know you've already sold 50 units, and so 5 is just unrealistic, so let's set it to this. So being honest in that discussion, but also giving some rationale as to why you are counter-offering and the range that you're counter-offering. It will move things, it will keep things moving very quickly in the negotiation process that way. And you want to be pretty flexible to make sure that you're structuring the deal in a way that's going to make sense. So if they want to pay less of a royalty up front because they have cash issues and are willing to pay you've agreed that it's $150,000 is the value that should come back to you. Whether you get paid $150,000 on day one or it gets paid out over a 3 to 5 year period, accounting for, of course, inflation and the cost of money, that's okay. As long as you're going to get paid that and it's a reasonable way of doing it, you want to be flexible on what that structure is because they don't have cash up front to give you that $150,000 today. As long as you make sure you are accounting for that value in delaying payment. So in the end, instead of paying you $150,000 over 3 years, they're probably going to be paying you closer to $250,000 because that's been spread out over time and interest and all that on it. So just be reasonable about that. And you will be able to achieve a deal much faster and probably better. But every time you give and say, okay, I'm not going to take the $150,000 today, but I want $200,000 and it'll be in 6 months. And you'll negotiate back and forth on that a bit. And then it structures from there where they say, no, I can't do $200,000, but I can do $100,000 in 6 months and then the other $100,000 in 12. And go, no, if you're going to pay me the second $100,000 in 12 months, it now needs to be $130,000 in 12 months for that second payment, and so forth. So it's flexible but reasonable, and find that deal structure that works for them as well as for you. Throughout all of this, communication is imperative. You want to be honest and clear and persuasive, but be understanding as to where they're coming from and working with them. If you're not talking on a regular basis, then the deal is not likely to go through. And if you stop talking because you're annoyed with each other, it definitely won't go through because you've got to work these issues out. So try to stay on the positive end. Even if you are disagreeing on something, talk about why you're disagreeing and why is that particular term important to them, and see if there's a different way to address that problem for them. So often in our marketing materials, we're highlighting the strengths, but you also want to make sure you understand the weaknesses of your technology, because if you don't, they will, and they'll use those as part of the negotiation process. You also want to know what their weaknesses are and see whether your technology in your know-how are really fitting into what they need because they have a particular weakness. Again, what portion of your technology is attributable to the product value, making sure that you're being reasonable about the percentage you're asking for. If any of you are familiar with some of the lawsuits and judgments that have come down from our Supreme Court and our circuit courts here, one of the things that was struck down was the 25% rule, that you couldn't, for infringement particularly, use that 25% of the profit is what is due to the licensor. The main reason for that was because they were not taking into account the attributable portion of the technology to the product. And so we do that right up front. And we figure out from that market research and through those discussions what portion your innovation is worth in that technology, so that when you calculate the royalty, it is defendable and it is rational and reasonable. And then the economic advantages. And this isn't just they're selling product. It could very well be they're selling a new product that they are coupling. So they had a technology first, and now they're adding your feature to it. So let's use the endoscopy example. You've got an endoscope, and that's pretty standard product out there. It's selling for about $1,000. You've got a new feature that you can add a fluoroscope to it, and it improves the capability of the endoscope so that the 3D resolution is much better. Well, they're still going to sell endoscopes, and they may sell those endoscopes for, rather than $1,000, $1,500 because it's more accurate. Well, that delta, that $500, is the economic advantage that you're now giving to them in selling their product for your technology. doesn't mean your particular piece costs $500 or is 1/3 of the cost to make the product. It may only be 10% more instead of the 50% increase. But the value you've brought to them is that 50% price increase. And they can sell that endoscope in the system that is very expensive. And so you could be adding value in the percentage of that package that you get. And where are you in the life cycle? For life sciences, for example, it can take a very long time for a technology or an innovation to reach the point that it is able to be commercialized. And so you may only have 7 years left in a patent. Or you may have 20 years, but it's a software, and so it's only going to be viable for 2 years. Be realistic about how long that technology is going to have value, and recognize that it's likely to decrease over time. And then any enhancements and the packaging of the technology, and how difficult might this be to design around. Software can often be very easy, and other things may be impossible to design around. Things that we look for in the market research, this all comes out of the technology assessment, is the market size, where the growth is, who the players are and their size. It also can help you in understanding how many units are going to be sold and what prices they're going to be sold. Any competing technologies, this will help you on the price points, and also to know who else you might be able to license the technology to. Any barriers to entry, they'll know that more than you will, but much of this comes out during the assessment. And that stage of development is really that commitment your licensee is going to have to make in order to invest in the technology to move it forward. How often does that technology change over? That's part of your life cycle analysis. And what else is going on in licensing in that industry? In some cases, there may be a tradition of no licenses, and it's just know-how that's transferred. So understand how players typically operate with innovation management. And there's other things that may be there too that are relevant for your particular circumstance. On the economic analysis of it, we take a look at price sensitivity and also what alternates they have. So that sensitivity analysis is really where else could they go, how else might they be able to pay for it, so that you know what your limits might be. You want to establish those walkaway values, so you will not take any less than X. And they probably have that value in their mind as well, that they will pay no more than Y. And so you want to know what those distinctions are. Make sure you can always support your assumptions and be very flexible in whether you're getting paid up front or later. There's all sorts of different ways that you can structure that. So we advocate being as flexible as possible, because all you care about is that total amount that you're going to be paid eventually, not how it gets paid out. And making sure that you are looking at both the licensor and the licensee's position to find that middle ground where both of you are going to get value and be able to move forward. So in the end, licensees will pay only as much as it costs them before they go to the next best alternative. And that next best alternative may not be a similar technology. It may be just selling their product at a lower price because they know somebody else is going to come out with this higher priced, higher functionality. So they may have a totally different business model that they may pursue. They will have a value associated with that, and they'll calculate that out. So be aware of the fact that they will pay no more than what their next best alternative might be. You will accept no less than what your next best alternative is, which could be somebody else that you're licensing it to. That's often the case if it's you're licensing technology out, or you may choose to keep it internal. We had one case where we did this analysis for a company that had new innovation for a consumer product. They were not selling directly to consumers. They were in the B2B side of it. And so they were trying to determine, should they license the technology or should they launch themselves and create a product line and sell directly to consumers. In the end, they decided that their potential licensees were not willing to pay them enough, so they were below that floor, and it made more sense for them to launch their own product, and so that's what they're doing, and that could be the next best alternative. Somewhere in between there is that range where you will find the negotiation goes back and forth, and you'll find that agreement on this is what we're willing to pay, this is what we're willing to take for it. And that's what you're trying to get to as quickly as possible in the negotiation process. So to wrap it up, when you're negotiating, make sure you're looking at an appropriate amount of investment in the process, and the investment is not just the marketing that you've done ahead of time, but how much time is it going to take to go back and forth. So in other words, you don't want to spend hundreds of hours negotiating on a $10,000 deal. So be reasonable. That could be your walkaway point, that it's costing you too much to negotiate, and therefore it's not worth it to just leave that deal away. Making sure you understand what their alternatives are, as well as what your alternatives are, because that will always help you in the negotiation process to know you've got something else you could be doing and don't have to take everything that they're offering. And be reasonable and rational. If they don't believe you, if you're saying, no, it should be 10%, and they're like, no, that's ridiculous, reevaluate the assumptions you have and make sure that, that you're being honest with where your capabilities are. We've seen licensors be just as unrealistic in what their expectations are as we've seen licensees try to lowball or pay as little as possible. Both sides have to really be accurate and reasonable on their assumptions and where they're coming from. And very importantly, communicate. Be honest and direct. You want them to be honest and direct. You're going to be in this relationship for a long time. If you don't trust them, you shouldn't be doing a deal with them. And so you want to be able to have open communications and work through whatever your conflicts might be. And then be creative. There's all sorts of different ways that you can structure a deal. So one deal does not fit all, and every deal that I've worked on has been different. I've never had a repeat. With that, I thank you all very much for your time, and I hope this was of help.